Good afternoon. I want to thank everybody for logging and calling into our webinar today, where we're going to talk about note investing and how to invest in different types of notes, but also doing so in a joint venturing capability. We have Ryan DeMent with us, who's going to be joining us in a few minutes with TruVest to kind of go over some of the ins and outs of joint venturing and doing so using notes. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA, and I'll be the moderator of today's webinar. I want to remind everyone who is listening live to the webinar today that you have the ability to ask questions during the presentation by simply typing your question into the chat box on the screen, and either Ryan or myself will make sure that we answer that question for you during today's webinar. Also, if you're listening to the recorded version on our YouTube channel or maybe on our website, Ryan's contact information, my contact information is given during the webinar, so please reach out to us with any additional questions you have after your conclusion of watching today's webinar. Just a quick note about Advanta IRA. Many of you are familiar with us, but for those of you who are not, we are a self-directed retirement plan administrator, meaning we hold alternative assets within different types of retirement vehicles. We have clients across the nation. We offer great customer service with our account manager, kind of personal concierge system of helping clients make investments and manage those different types of investments within their IRA account. We like to provide a lot of knowledge and education, and we do so through our Learning Center. We offer a lot of events, whether it's a live seminar in either our Atlanta or our Tampa office. We offer webinars like the one you're listening to today as well for people to really take in as much information as possible. We believe very strongly that the individuals who are working with us or who are thinking about working with us here at Advanta really should be educated and knowledgeable about self-directed IRAs and a lot of the other ancillary topics that we discuss here at Advanta. So that's why we bring guests today, like our guest today, Ryan, to give their expertise in a particular area of investing with your retirement account. So we like to provide those individual guests. We also provide a lot of our own educational webinars talking specifically about self-direction. Now, today's presentation, I am not going to talk too much about self-directed IRA accounts. It's more the focus on doing some joint venturing, whether you're doing so with an IRA or not. But to find more, you can certainly go to our YouTube channel and find some of those recorded webinars where we do talk about using your IRA to invest in real estate, LLCs, notes, and so much more. We have that on our on-demand Learning Center portion on our website, and again also on our YouTube channel as well. Now again, most of the individuals on the webinar have probably heard about self-directed IRAs, so for someone maybe introducing this concept for the first time, kind of why haven't I heard about the ability to use my IRA to invest in alternative assets? I think the biggest reason why is that most IRAs, most 401ks or plans that individuals have for retirement are held by a bank, they're held by a brokerage firm that's going to offer them limited investment products. You know, Charles Schwab, Fidelity are great companies to hold mutual funds and stocks, but they're not in the business of allowing individuals to invest in real estate or notes or private placements, other things that we hold here at Advanta. So they're certainly not going to tell their clients that these investments are possible. It just simply doesn't make business sense. But IRS regulations do allow for a very broad range of investments, and self-directed IRAs are how you make those different types of investments. Now, the types of accounts you can use if you're thinking about self-directing, any type of IRA, whether it's a traditional or Roth individual account, whether you have a small business or you're a sole proprietor, you might be able to set up either a SEP IRA, a simple IRA, or perhaps even a solo or individual 401k plan. We offer all of these different types of IRAs and accounts here at Advanta, as well as education and health savings accounts as well. So all of these accounts follow a similar set of rules as far as investment options. So again, to learn more about these types of accounts and some of the other different investment options and the rules, please check out some of our other webinars we've done, or maybe sign up for one that we have coming up soon. Now, individuals who have money in IRAs, they have money in 401ks with other employers or with other companies, how do you get that money moved into a self-directed IRA? Well, it's simple. You can either transfer money from one IRA to another. You could do a direct rollover from an old 401k or an old 403b plan into a self-directed IRA. And moving funds, as long as the money's not touching your hands, either by doing a transfer or a rollover, That money gets moved from your current account into your self-directed IRA with no tax consequence, and you have the ability then, once the money is in the self-directed account, to make an investment. Now, the transfers and direct rollovers within IRAs are unlimited. So you can move as much or as little as you like from one account to the other, and do so many times during the year. So it's certainly not an all or nothing proposition when you're talking about self-direction. You can carve out just a piece of your retirement portfolio that you want to use for the alternative investments. And most importantly, when we start talking about investments that are held within an IRA and the returns you get on the investments, those are unlimited as well. Now, just some of the different types of assets that people hold within a retirement account or a self-directed retirement account. We deal with a lot of real estate, and again, a lot of today's focus with having Ryan on is going to be talking in the realm of real estate investing. You can hold actual title to properties, whether it's a commercial property, whether it's a rehab or a flip, timeshares, residential, single-family homes, condos, duplexes. Your IRA can be on title to and own a piece of real estate as an investment. Again, there's some rules you have to follow. It's got to be strictly for investment. It can't be something you're looking at using personally. But your IRA can certainly be on title to a piece of real estate. Now, in the other real estate realm of assets that we see, and we're going to talk a little bit more today about Ryan in just a moment, are kind of paper assets. Individuals investing their IRA in the form of a mortgage loan or an unsecured note, where your IRA is standing in the place basically as a bank would and being a private lender. So for some individuals, they don't want to have their IRA own a piece of real estate and then be responsible for the tenants, the toilets, all those other different potential issues. Instead, you can have your IRA set up where you can simply lend money from your account to somebody else and have your IRA again sit in that position as a bank. And we see that done a lot with mortgage loans, unsecured notes, and also, as you can see on this list, joint venturing, which is we're going to talk with Ryan about here in just a few minutes. Now, the types of private lending, when it comes to having your IRA act as a bank, those same types of loans that you would see advertised at a bank, 15, 30-year mortgages, adjustable rate mortgages, balloon notes, etc., those can all certainly be held within an IRA account. It can be a shorter term transactional funding, can do unsecured notes, and again, you can do some equity participation, which is the joint venturing that we're going to talk about here with Ryan in just a second. So there's a lot of different types of lending, a lot of different collateral you could use. Most of the collateral that we do see here at Advanta is real estate, a home, a condo, some type of actual physical real estate structure being used as a collateral, but you could use other types of assets. We've had clients use farm equipment, automobiles, and livestock as collateral for a loan. And the benefits, I think, of doing private lending in your IRA is you could really get to act as a bank and determine those terms. You working with your borrower can decide how much you're going to lend, what the interest rate's going to be, the payment terms. Is there any equity participation or joint venturing arrangement between your IRA and that other party? So that's really you getting to sit in that banker's seat and determining those terms. And by doing so, you can ultimately maybe set the rate at which your IRA is going to grow. If you know that you're joint venturing or you're lending money to an individual and this is going to be the return that you get from the investment, then you know exactly what your IRA is growing at. You're not worrying about the stock market. You're not worrying about geopolitical forces influencing your IRA in the market. You know this investment is paying off a certain return. It can also be a very low maintenance asset, just lending money. Again, as I mentioned, if you owned real estate in the IRA, you'd be dealing with your tenants and your toilets. If you're simply lending money to someone else, they're taking care of that and simply lending the money to you. So at this time, I want to bring Ryan in. Ryan from TruVest is our guest host today, or guest presenter, going to be talking about investing in real estate notes via joint ventures. And Ryan is the founder of TruVest. He has over 15 years of management experience in aspects of finance, operations, and real estate. But during the last 4 years, Ryan has really focused his attention on investing in a company or starting a company that buys and sells both performing and non-performing notes. So we're really happy to have Ryan on today, again, who's going to talk to us about joint venturing within your IRA. And before I have Ryan come on, I want to just remind everyone who's listening live, If you have questions, please type those into the chat box on your screen. We'll make sure we get to those questions at some point during the webinar. But at this point, Ryan, are you there?
I am. Thank you, Scott.
All right, Ryan. Well, I'll tell you, I'm going to turn over the presentation to you. I'll monitor the questions, and then please, everybody, keep them coming in the chat box.
Okay. Thank you. Welcome, everybody. Thank you for attending. Good morning, good afternoon. Wanted to talk a little bit about real estate note investing via joint ventures. My last webinar that we had in June, we talked a little bit about note investing. And this round, wanted to kind of just talk about a little bit about note investing, joint ventures, and what it kind of looks like, and some of the ups and downs I've had in the actual industry. So today I wanted to go over a little bit of the outline. Note Market 101, just to kind of give you a high-level overview of what the note market looks like today, what's transpiring, how big is the market, those type of things. The note landscape, the different levels of the note landscape, there's the primary and the secondary markets, cover a little bit about that. Knowledge is power. I'm going to share some of the learnings I've had from being in joint ventures myself, and just talking about the ins and outs of knowing what you need to get into when it comes to a joint venture. And then joint ventures, no heavy lifting. If you're going to put out your hard-earned money the first time, why should you actually have to work hard again the second time? So I'm going to talk a little bit about that. And then superpowers that come out of joint ventures, all the great benefits that we actually do from an actual joint venture. And then dive into the hopper. We're going to share some examples that we've done, some that are available, and talk a little bit about what we're doing in the coming weeks and months. And then a little bit about us, our typical approach, and then our story, and kind of how I got into the business and how TruVest came about. So, Note Market 101. Well, I just want to give a brief overview. They're basically financial instruments that we secure interest in real property. It can actually be a single-family residence. It could actually be a commercial property. It could actually be empty land. It's just that financial instrument that typical lenders use to secure a property, land, whatever, a hard asset with, so they actually collateralize it. Part of this industry, there's also another smaller piece that plays a very critical role, is what I call owner financing, and it's how we somewhat started in the business, and it's where Scott described earlier, is where you play the bank. You make the decision on what you want to lend and how you want to lend against real assets, whether it be, like I said, single-family residence, commercial properties, or land. That's your choice. But in 2016, that was a $10 billion industry, and it's expected to grow even larger in 2017. And then another piece of the business is non-performing notes. So this is all-encompassing. It could be owner financing, trust deeds, land contracts, and mortgages that are originated by lenders like JP Morgan Chase, Wells Fargo, Bank of America, larger banks, credit unions, and that so forth. Just in the second quarter alone in 2017, there was $20 billion of non-performing notes that were sold. That doesn't mean there was not more. That is actually what was executed within the actual, what we call the secondary market. This excludes the Fannie and Freddie sales. Those are very large sales that are actually typically going to either another primary lender like Bank of America or Chase, or going to a hedge fund. And those typically run in the hundreds of billions of dollars. The last sale that came through from Fannie was $113 billion. So it's a very large portfolio. And those are all, they're primarily firsts, but they do have seconds in there. But that is a totally different market that we can have another webinar on that we can talk about in the near future. And then last but not least, non-performing notes can be bought by lenders, banks, and credit unions. Building those relationships up is the biggest task that one has to do to be able to get access to that market. But once you do, you can actually have the ability to buy directly from the larger players in the industry. Not saying you can go out and buy directly from Chase or Bank of America. They typically are looking for somebody to come in with a line of credit of $1 million or more to get in, to where you're actually trying to buy directly from them. We've started out in the industry to where we actually have started with smaller financial institutions, credit unions, and regional lenders, and we've worked our way up to where we can actually get roughly about $20 to $30 million of forward flow on a monthly basis that we get to review so where we can actually purchase those notes in the future. The note landscape, I touched on this briefly. There's the primary market, and this is primarily focused for banks, credit unions, regional lenders, and other financial institutions. This is where they're actually originating the majority of the loans through a mortgage. And we all know what a mortgage is. We've seen it, done it, touched it, and had to go through that process. The secondary is, like I said, this is where we're buying in the market, and you're going to have large institutions in there. You can have hedge funds, small, medium-sized investment companies, or you can have individuals buying in this market. If they have a relationship with a lender, they have the ability to buy directly from those lenders that are in that primary market. Also in the secondary market, we have investors that go in and actually purchase directly and want to be able to keep these loans for themselves. And then what they do is they make them reperforming. So there's plenty of different exit strategies we can touch on, later in the presentation. But I've got some listed here as, ideal exit strategies for loans that you're going to keep and you're going to make them reperforming would be a loan modification, reestablishment of payments, and then a deed in lieu. There's other options, of course. There's, foreclosure, there's forbearance, there's the ability to reduce payments, for somebody and then get them back on a tiered plan of payments to get them back on a full P&I payment. So there's all types of different options in this realm. That's just the non-performing side. The performing side, like Scott said earlier, is you have the ability to control your own destiny and create your own ROI with the notes that you actually write by coming in and understanding the dynamics of being the bank and being able to carry that note and fund it just like a bank. So there's a lot of different pieces there you can look at going forward. Knowledge is power. These are my learnings, and I share it with everybody else. Things that I've made mistakes with, things that I've learned, things that I like to share. The number one thing that I always preach, due diligence. In anything that you do in life, whether it be personal or business, I always preach that, and that's one of the biggest things I like to look at is if I'm going to go into business with somebody or I'm going to give my hard-earned money to somebody else, I'm going to make sure that I'm doing due diligence on the entire package. The company, the actual transaction, what are my responsibilities in there? Is the documentation put together properly? And then what does the actual outcome look like? What are my expectations for a return on investment? Next piece, transparency. I mean, if somebody's not willing to share with you the total details of the transaction, I'm shying away from it because I do not like to have surprises. So making sure that you see everything, ask questions, look at the documentation. If you don't understand the documentation, maybe you engage somebody of a professional like an attorney or somebody that has this knowledge to provide that to you. If you're working with a company that's not looking to give you that information, for me, I run away. I just step back and go. It's just not something I want to deal with. I want to know what's going on. Does the investment vehicle make dollar and cents? And that's just my crazy way of saying is, does it make sense for you? You worked hard to earn your money the first time. You shouldn't have to work hard the second time. Are the returns crazy? Does the investment and the actual asset match up? Does the transaction make sense? Piecing all those pieces together should get you to the end result is everything going to line up so you can actually make a decent return? And also at the same time, making sure you're dotting your I's and crossing your T's to make sure it's all legally approved and you're not doing anything crazy or out of the ordinary. Being kept in the loop, communication is key, and I enjoy keeping our investors, our clients, my partners in the loop. Transparency is a big key to this, but also the communication piece. Understanding, you need to understand what's going on and how things are going on. So maybe it's a once-a-week email or a bi-monthly phone call, whatever the case is, making sure there's communication back and forth so you know exactly what's going on and there's no surprises. The last two I've kind of touched on, but I'm going to go over them again, is know your responsibilities. There's going to be times in there you can get into a joint venture, and I can tell a little bit of a story of mine. I got into a joint venture when I first got into the industry, and there was not enough transparency within this joint venture to where I did not understand or know that any type of legal fees or any type of additional fees was my responsibility and not the company I was working with. There was no 50-50 or anything to that extent. It was me as the investor. I needed to make sure I was paying that. I didn't check everything. I didn't review it. Was it a ton? It was a smaller house. It was about $2,500 I had to come out of pocket. To say the least, shame on me, but I didn't actually do another transaction with that company again. But I learned a lesson to make sure that's all put out front, to make sure I know exactly what my responsibilities are for any type of joint venture situations. And last but not least, don't be afraid. Get it reviewed by somebody that you trust, an attorney. Make sure that it passed muster. It actually gets you where you need to go. Protect yourself. It doesn't hurt to have a second pair of eyes review your documents and make sure that you're getting into the right investment at the right time.
Hey, Ryan, if I can interrupt, I have a quick question for you. You're talking about obviously doing this due diligence, getting a legal person on board. How do you find, at least the people that you want to have help you with your due diligence or help you legal team? Do you work with other investors? Is this kind of an interview process you do? Can you tell us a little bit more about how you find those other individuals to lean on?
So over the 4 years, I've, again, made some mistakes, and I've done some, really good things. It's been trial and error. I came from the financial industry, and I had some background already with working with some of these types of vendors in the past, so I had a leg up. But the other piece was just sheer due diligence. Talking to people, sharing my information with other investors, sharing my information with other individuals that I spoke to in the past. But then it boiled down to the time and effort on the due diligence piece. So vendors, we have a nationwide vendor that does our property inspections when we go out and we're looking at buying a property through a note transaction. They go out and they will check the property to make sure that everything is up to snuff. Is it always? No, and we don't expect that. But I've gone through 3 of those vendors in 4 years. The other 2 that we've had, they basically were just doing drive-bys and not doing a lot of work, but they were recommended by other individuals within the industry. So then I stepped back and said, okay, I need to do a little bit more homework. So then I started digging into, Better Business Bureau and calling actual people that are clients of theirs that I found through other connections, other than actually talking to the vendor directly and saying, hey, please give me a referral. So spending the time there is where I've really focused to be able to create that vendor group that supports us, because if we don't have them in place for our business, we won't succeed in any aspect whatsoever, because we're in multiple states, and I'm in Utah right now, and we're buying houses in Indiana and other states. I can't be there always. So having another set of eyes that I trust, and I know they're licensed and they're bonded and they have all the right credentials to do their job, that's where I feel comfort in what we do and how we do it. The other piece of it is, and I'll tell you a little bit of an anecdotal story. The first 2 had the same information and had all the credentials. It just, their attention to detail didn't match up to what I was looking for, and I was looking for a little bit more. And when I say a little bit more is, when we do a drive-by on one of these, we like to take pictures of the house, and if we can get in, if no one's in it, I like to take pictures of inside the house and look at, is the electricity on, what does the neighborhood look like, and so forth, and what's the condition of the house, and so forth. They would just give you the basics, and then they would come back and say, well, if you need more, we're going to charge you more. Well, that's not how I do business. I mean, I set my expectations up front, and I make sure that I put them out there, and I thought I was pretty clear with it, and then clearly I wasn't. So at the end of the day, I had to go find somebody else, and through trial and error and some more due diligence, I was able to, find my current vendor that we have, and we've had them on for a little over a year now, and they've done a phenomenal job for us, and we enjoy working with them, and they refer us out to other vendors that can help us out, and it's just a great connection, and it allows us to continue to grow the business in other aspects.
Thanks, Ryan. I think that's great. Again, if anyone else has questions, please get them typed into the chat box on your screen.
Okay. No heavy lifting. So one of the things that I've learned from my prior joint ventures and working with other companies and investments is I didn't want to be doing all the hands-on work for the investment. I don't mind getting my hands dirty if I need to, but if I'm looking to get into a joint venture with somebody, I want to be the person that's in the background that's supporting the process, not the person that's actually doing it. So some of the things that I've come across in my experiences, the first thing is documents. We all need to have documents. Unfortunately, it's the way of the world. We have to have all these legal approved documents that go out for these investments. Well, there was times where I couldn't get documents delivered to me via email. I had to get it delivered via snail mail. That's just not in today's society. We should have something delivered easily to you, whether it be email. I mean, if we have to do a FedEx or whatever the case is, that's fine. But it shouldn't be difficult to get those documents to you or anybody else. Opportunities, they should be tailored to your needs. What you're looking for and what you're looking to get out of it, it shouldn't be somebody's trying to force you into an investment vehicle that doesn't make any sense to you, and then, oh, by the way, it doesn't match up to what you're trying to get out of the investment. So making sure that it's tailored and making sure that we understand, you understand, the company understands that this is what we're looking to do. I mean, it's that back and forth, that communication piece that is very critical in these. The terms should be straightforward. It should be outlined in all your investment documents. You should see it in black and white. There should be no questions asked. I mean, that's a big thing for me. There shouldn't be small print where you have to go find where 2 months you get, an interest-only payment, and then 1 month you're going to get a principal and interest payment back, or your share at the end of equity is only 40% when it should have been 50% based upon these different benchmarks. Those are crazy. Those are just crazy terms that you shouldn't have to get into. You should be able to discuss the terms up front, know exactly what they are, have them be put in black and white, put in the document, not change. End of story. Said this earlier, but always in the know. Know what's going on. Having that touch base, understanding what's going on. We know that in my experience too is not everybody wants to have that daily touch point or weekly touch point, but at least having a somewhat monthly touch point to understand what's going on, that's good because you will be informed, but it also puts you in for me, and this is another experience, puts you at ease. You know that the company is doing what they're supposed to be doing and they're running the process how it should be to make sure that your money is put to work and it's earning that ROI that you're looking for. Your financial goals align with the investment. Again, that's back to the tailored investments. If you actually understand what you're getting into, the company is understanding what you're looking for, they should be able to fit you into an investment that works for your needs. Whether you want to invest $5,000 or you want to invest $100,000, there's always something in between or at both ends of the spectrum that works for you. But having that open communication is key and making sure that you're working back and forth with that company on your joint venture. And then last but not least, I've learned this from personal experience, rehabbing and tenant issues not required. I'm not a big tenant and toilet and rehabbing guy whatsoever. We do have rentals in our portfolio, but my biggest thing is I got into note investing is to be the bank, not to be a landlord, and getting that 2 a.m. phone call that tells me that there's a toilet overflowing or there's some type of issues going on with the air conditioning. I know there's property management companies for that, but at the end of the day, I like being the bank. I like being able to hold the note. I like being able to work with the homeowner to get them back on their feet with if they have any issues. I also like providing owner financing. It's just a lot friendlier from an investor side when it comes to doing all the work. I'm not afraid to do it. It's just I've got other things to do in my life, and having to worry about getting a general contractor and then making sure that we tear down a house to the stud and then making sure we pull all the permits and everything. That's a lot of work. If we can actually minimize that and be able to be the bank through this process, it makes life a lot easier for you from your standpoint as an investor. It makes life a lot easier for us as a joint venture company. And then the other piece of it is it just makes an overall easier transaction because you're not having to worry about all these surprises that could potentially come up in these costs when you're doing this. The flip side of this is, let's say we buy a non-performing note. The homeowner says, you know what, sorry, I want to walk away. We do a deed in lieu. That's fine. Friendly foreclosure. We walk away. We potentially give them some cash for keys. Great. We get into the house, and the house needs some work. Well, that's going to happen sometimes. That's when I have to come in and say, okay, we're going to have to do some work. We're going to have to get a general contractor out here and go through the process. Most of the time when you're buying a house in this status or in this situation, it's going to need some type of work, whether it needs painting, carpet, flooring, kitchen work, whatever. It's going to need that, but it's not going to be the extent to where it's going to be a tear down to where you got to take everything down to the studs and then rebuild it back up. It's going to be more in the realm of let's get it ready to be a rental ready house, and then we can turn around and sell it through our multiple channels that we have, where it could be through a real estate agent. We can sell it back on contract, which is owner financing. We could make it a rental if we wanted to. We could do lease to own, or we could actually just sell it outright to somebody or to another investor. So there's different opportunities there, but I just want to be open and honest about it. There is some manual work that needs to be done and some rehabbing potentially in the background, but it's not like when you buy a house at the foreclosure auction and you have to go in and completely tear it down and then bring it back up from the studs and do all that work. All right. This slide, joint venture superpowers, I thought it'd be a little creative and a little crazy. But these are some of the things that everybody gets out of a joint venture, especially when you're working with notes. Homeowners that are in distress when it comes to their mortgages, they're getting some debt relief because we have the ability to forgive principal. We have the ability to forgive interest. We have the ability to adjust payments. We have the ability to put them on forbearance. There's options that we have for that homeowner. It's not just I'm going to evict you or foreclose on you and take the house back. Where we do our best, whether it's from a financial standpoint or a social aspect, it's all about keeping the homeowner in the house. So that's our number one goal. When we're working with non-performing notes, we want to keep the homeowner in the house because after a period of time, 12 to 18 months, we have the ability to then sell the note on the open market, and it typically fetches anywhere between 84 and 96 cents on the dollar. It just depends on the homeowner's credit and payment history, and of course the house and a few other things. So there's options there. Communities are revitalized. It's helping communities. I mean, we're putting people back or keeping them in their houses. We're allowing the community to continue to grow. And we're not having issues with foreclosures and so forth. So helping communities, economies are stabilized. Again, we're keeping people in their houses. But the other piece of it is, if they're back on solid ground, they're able to go out and spend again. They're not actually staying in their house or trying to hide. They're actually helping the economy. They're getting back on their feet. They're out doing their thing, and it's helping the local economies. Local governments. The thing is, typically when we see these non-performing notes, local governments experience an increase in tax revenue. They're seeing additional tax revenues come in from us, the note buyers. And when I say that is, we typically will find houses or notes that are non-performing that are past due on their taxes, their property taxes. Well, part of the purchase is we have to pay the property taxes. So now they're starting to see tax revenue come in. Distressed assets become performing. Scott, was there a question there?
I did. I had a question about this. Somebody asked, we were talking about, just going back up to your part about keeping homeowners in the house. They want to know how that's different from being a landlord if we're talking about, I guess, joint venturing, being a private lender. But maybe just expound on that briefly a little bit. Or maybe that's going to be covered up in an example we go through.
How it's different from a landlord is we're the bank, so we're not having to deal with tenant toilets or any type of issues. So when you're behind on your rent, and I'll give you an example, we've got a rental here in the past that we had problems with. If they cannot come up with the rent, unfortunately, you've got to evict them. But who comes back from a rental as a renter and says, hey, can I pay a lower monthly payment to stay in the house? I don't know very many people that do that, but again, with a note, since you're buying it a non-performing note, if you're buying it at such a substantial discount, typically at 30 to 50% of the unpaid balance, you have some wiggle room there to work with them on that principal interest payment. By doing that, now you have the ability to keep them in the house. You're still the bank, and you don't have to worry about any of the issues that come along with the house. So being a landlord in that piece, there are two separate items. Being the bank, you're worried about the asset, making sure that they're making that principal and interest payment on a monthly basis. Being the landlord, you have to make sure that you're getting the rent, and then, oh, by the way, you've got to do all the upkeep on the house going forward or during that rental period. So you have those additional expenses there.
Okay, thanks, Ryan. Go ahead and continue on.
Okay. Cool. Distressed assets become performing. This is what I discussed earlier. We talked about after 12 months, we can turn a non-performing note into what we call reperforming, and it allows us to sell the note if we wanted to, or we keep it on our books and use it for income coming through. The American dream is alive and well. This is two pieces. People want to, there's people out there that can't get a loan from a traditional brick and mortar bank. That's where companies like us, investors like you, come in and do private lending. You can come in and buy non-performing notes, help people out there. So keeping people alive and ready for that American dream is huge, because at the end of the day, we like to see people stay in their homes, and we like to provide that owner financing and that opportunity to be able to buy their home. And it's such a great feeling when we have somebody that buys their first home through us. I mean, it's a phenomenal feeling that, they've been turned down by 5 or 6 banks or whatever the case was, and they come to us and we can get them together. We set the terms. Does it make sense for us? Does it make sense for them? Does it make sense from an ROI perspective? Once we put all that together and everything lines up, we send it off to our funding company and we take care of it and get them into that house. It's a great thing, and it's a great feeling. It's a great service. And then last but not least, I know it's on everybody's mind. Investors can earn return, superior returns secured by real estate. When you're in joint venture, both the company and yourself, you guys actually own the asset. So at that point in time, you are now a bank. You're holding an asset, whether it be a non-performing or performing. You now actually have secured real estate. So if something does go awry, you have the ability to execute and be able to take the asset back, and then either sell it, put it on owner financing, or go through the other options there. This slide, I just wanted to show you guys some basic deals. we've started and we cut our teeth in Evansville, Indiana. It's a small city that's about an hour and a half north of Louisville, Kentucky. It's a blue-collar town. Average salaries roughly about $45,000 to $50,000 a year. The houses that I have pictured on here, these are houses that we own and houses that we have for sale or we're going to take down through a note transaction, so they are available for investment. But what I wanted to show you guys here is these pictures here are actually current status of houses, of these houses in their current state. So by all means, we're not buying notes that are in the best condition. The house on the upper left-hand side, it's probably one of the better houses that we've bought in the last several months as in condition. The surprise about this was when we used our vendor, we found out that this house was actually zoned for a duplex. So we're working through the process to look at, okay, do we want to have it set up as a duplex or do we want to leave it as a single-family home? This is a note purchase. It is non-performing. It's past due. There's no one living in it. The current owner has been at least keeping it up. You can see from that. So not a bad asset there to look at. Upper right-hand side, this is a current rental that the owner is looking to sell. We do buy, rentals or properties outside of just note purchases that we can find through, owners that are wanting to sell their rentals, tax liens, any type of note sales, like I said earlier, but it's not the only one. And then the last is just people reaching out to us saying, hey, we have a house for sale. We want to sell it. So we look at all different channels. This is coming from an owner that we have built a relationship over the last 4 years. It's a rental. He's looking to get rid of it. So we're going to actually go check this out. What we're doing next week is we're actually going out to Evansville, Indiana. We have 50 properties we're looking at, and we're going to go property by property and take a look at every single one of them. Some of these are note transactions. Some of these are rentals. Some of these are vacant. It's just a hodgepodge group of houses. So we're looking forward to that. The bottom left-hand side house, that is the current state it's in. It is a note. It is also non-performing too. We haven't done the inspection on this or had our vendor go out there since we were going to go out there next week. I'm not sure that someone lives there or not, but that is unfortunately the sad state that it's in. This house was built in the early 1900s. It's actually quite large. It's almost 2,500 square feet. It's atypical for Evansville, and it's one of those houses that caught my eye. And if it doesn't need a lot of work and it makes sense from a dollar amount, we're going to go in and purchase that. So I'm excited to see that one. And then the bottom right-hand side, this is a house that we actually own. This is a rental that we've had for many years, and I'm slowly but surely getting out of the rental business. And the renters have moved out of this. This is a house that we're going to do some light rehab on, since it needs it. You can see from the side of the roof on the left-hand side, it needs probably $5,000 to $10,000 worth of work. And then we're going to actually sell it on contract. So we have some people that are interested in purchasing it on owner financing. So we're excited about getting that going. So that's going to also start next week.
Hey, I just wanted to make sure everybody join. While we're getting close to the end of the webinar, if you have other questions, please get them typed into the chat box on your screen so that either Ryan or myself can get them answered.
And then the last several slides are a little bit about us. Our atypical approach. If you've attended our last webinar, you've seen this slide before. This is a little bit about me and a little bit of spin on a few other things. I like to do things a little bit different. I'm not typical. You can see from our slides we're definitely different. I focus and pride our business transactions by tailoring investments, straightforward terms, true partnerships, and customer and social moral compasses. these are things that are very at my core and at the business core. It's my passion. I want to make sure that if I'm going to go into business with somebody, that they know exactly what they're getting into and they know exactly who we are. It's just the best way to do business. I don't like to hide things from people. I want to be upfront and honest, whether it be good or bad. I want to make sure that you understand exactly what you're getting into, no matter what. I'll tell you, if this is going to be a rough investment and here's the reason why, I'm going to tell you. If it's going to be great, here you go. It's just one of those types of conversations I like to put up front to make sure that we have no issues going forward. Part of us and part of what we do is the social and moral compass, and also being customer-centric. We live by the golden rule. We want to be treated like everybody else is. We want to be treated fairly and equal. We translate that to you. That's our number one goal. Goals for both parties involved are key and critical, and we want to make sure that you have the ability to understand what our goals are, and we want to make sure that we understand what your goals are, and then we can marry the two together. And the last but not least is I like to make sure everything is on the up and up. I spent 15 plus years in the financial industry. I still dabble in it, and one of the biggest things is we're in a highly regulated environment. The regulatory environment has changed over the years, and I want to make sure that we're doing everything on the up and up. We're dotting our I's and crossing our T's. I'm not looking to get in trouble by any type, and I use this loosely, alphabet soup, FDIC, CFPB, SEC, the list goes on. Those are the three that I stick out in my mind. But I'm not looking to get you in trouble or myself in trouble or our company in trouble. So we're always going to make sure that we're doing the right thing. You'll see on 2 slides from now, we have a very good general counsel that takes care of us. He makes sure that our I's are dotted and our T's are crossed. He does not mess around. We make sure everything is on the up and up. And if he doesn't have the answer, we have the ability to go across his actual firm to figure out, is there somebody else in his firm that can help us? Or at times we've actually gone to outside counsel from that point and actually got some information. We want to make sure we're compliant. And that's where our vendors come in too. Vendors are key in this industry. If you're not using an approved, accredited, licensed, bonded vendor, you're putting yourself in trouble. I mean, an example, if you do an owner finance deal from a contract perspective, from a CFPB perspective, from a Dodd-Frank perspective, you can only finance 5 of those a year as a company, an individual, whatever you want to do. At that point, Dodd-Frank then tells you and dictates to you, you're considered a mortgage lender at that point. You have to be licensed and bonded in the states that you're doing business in. Well, I'm not looking to get into that business, so I had to find a vendor that was licensed and bonded in all 50 states that actually specialized in owner financing. It took me 2.5 years to get that right, but we've got that right, and since then, it's been a great relationship. We found the right company. They handle everything. So an example of this is, as we work through an owner finance deal today, we can talk to the prospective homeowner, but after that point, once we get to a negotiation piece, we have to back out because we've done more than 5 deals in the year, and now we have to turn it over to our mortgage lender, and they have to negotiate on our behalf. They know our terms, they know our requirements, they have our best interest at mind, but they also know that we're not looking to shortchange the home buyer, the prospective home buyer. So we will find some way to work in the middle. Making sure that you know these things and doing things right the first time will keep us all out of trouble, because typically when the CFPB comes in and audits you, they're not going to walk out without fining you of some sort. And the typical fine in this industry is anywhere between $500,000 to $1 million per occurrence. So if you have 2 of those, there's $1 million, there's $1 million to $2 million. That's a lot of money. Not looking to get anybody in trouble, so we're staying away from that.
Hey, Ryan, I had a couple questions come in. I want to make sure that we get to these too before we get to the end. Someone asked kind of what the average rate of return you see, and what is the average time it takes the note to sell, and then the return provided to the investor?
Typically, we're seeing anywhere between on a low end of 10% and a high end of 15%. There are some investments out there that we've purchased in the past that have earned more than that. It just depends on the front end. And when I say that is, it's like anything else. If you buy it right and you're able to get the steps in between, which means working out the loan modification with the homeowner, or if you have to do a deed in lieu, how much work do you have to do to put into the house before you can sell it? So it's kind of different. That's non-performing, and then performing is really up to you. And I'll tell you this, there's no one else in the industry that does this, is we offer a flat rate of 6.5% interest on owner financing. No balloon payments, no crazy terms. That's whether you have A paper or D paper. It doesn't matter. We don't discriminate. We don't worry about anything. You come to us, that's the terms you get. The beautiful thing about that is we write into our owner finance deals is that we allow the homeowner to refi out after 12 to 18 months. It's at their choice. All of their payments are being sent and recorded to the 3 major credit bureaus. By doing that, we're establishing their credit. There are mortgage brokers out there, mortgage lenders, that will work with these individuals after 12 to 18 months of established payments to where they can actually refi them out and get them a better rate. And then, oh, by the way, we get paid off almost whole at that point. It's anywhere between 92 and 97 cents on the dollar is what you'll see from those. Those are typically FHA loans, and it's a great opportunity for the home buyer to be able to have that opportunity after 12 to 18 months. Now, that being said, return on owner financing is dictated by us. Some basic terms, we typically want no less than 10% down. We typically see between 15 and 18% down, and then we like to stay within the 20 to 25% debt-to-income ratio when it comes to payment to debt to keep them safe there. With that being said, you're looking at anywhere on a low end of a 9% return on performing all the way up to 18%. Again, that's a range. We also have bought some that we've also funded some that have returned 30 and 40%. It's all about how you purchase it and what the investment looks like, and then how you work it on the front end. Again, it's the purchase, the down payment, the monthly payment, and then where's the asset at? Is the asset in an appreciating area? Is it just flat? There's a lot of different things, and those are finer pieces that I like to talk to individual investors on a personal level so we can figure out what they're looking for.
Yeah, just another quick question for you, Ryan. Do you do any, someone was asking if you do any commercial properties, or is it strictly residential?
We do well, I don't want to say strictly, but we do, our primary is single-family residence. We do have, one of my partners in the business does do commercial, and we do work with some entities on commercial financing. Okay.
Another question said they may have missed it, but was the basis for your initial funding yours or a pool of your partner's assets invested in a self-directed IRA which fueled your company? I think the answer to that's no. I mean, you can work with self-directed IRA investors, but your company wasn't founded using self-directed IRA funds. Is that correct?
Correct.
That's correct?
So
okay.
That is correct. We did, so the start of our company did start out with our own funds. We've made our own mistakes with our own money starting out, and we've had many of them just like everybody else. And from here on out, we have our own funds working on projects. We also have investor funds working on projects. There's also another piece of our business that we're rolling out is a 506c offering, which is a real estate fund that people can also get into also. So to start out, we did not use a self-directed IRA, but it was our own funds. It was in an LLC that we worked through. Just in recent years, we've come across self-directed IRAs, and that's why we're here with Scott, and we think it's a great investment vehicle for everyone.
Okay, yeah, Ryan, if you can finish up the last few slides. There's a couple of people asking about how they get invested, possibly in certain properties, or how to do so. Basically, I think we get through the rest of the slides, they'll find out how to get in touch with you and reach out to you to get that process started if they're interested in learning more.
Perfect. I'll just go quickly over our story. 2008 market crash. We had a big issue in the real estate market, and I lost a lot of my 401k just like everyone else did, and I was trying to figure out what could I do to help myself and my family. My parents are part of this business, and I have some nephews in this business, and this is part of me trying to figure out what is our core business going to look like going forward. And the typical investment vehicles were not meeting my eye, and I don't like to do anything typical. I wanted to find different things. We got into owner financing by dumb luck by my good friend that was looking to buy a house, couldn't qualify for a mortgage. The owner, in short, basically said, hey, I'll carry a contract for you. We had no idea what that was. We went through the research process, and boom, here we go. Like I said earlier, we offer a fixed rate of 6.5 on every contract that we carry. There's not these balloon payments at the end. We're not offering 15 or 18% interest rates, which are all usury. That's a brief story on us. You guys can read that, share that information. We can talk further about it. Our team, I'm in the center. Excuse me, I'm in the center. My parents to the right, Lenore, Earl. Upper left-hand side is Randy Marco. He's actually on this call. He's one of our trusted advisors. Excuse me. And then on the right-hand side, we have Josh. Josh Freeman is our outside general counsel. He is the guy that makes sure that everything is going smoothly on the legal side. We couldn't live without this guy. He keeps us up to date on every regulatory piece. Excuse me. And then Peter Boards was an advisor, and he's come on board and actually has become a partner in TruVest. So we're excited to have him on board, and we've got some great things coming along with the TruVest brand. And then last but not least, earning disclosures, all the fun stuff that we have to do. That's Josh telling me that I've got to do all the right stuff and keep everything on the up and up. Last but not least, contact information. Sorry about the thank you. It's a little out of the whack. I didn't catch it before I sent it over. My contact information is on the bottom right-hand side. That is my cell phone number. I answer it as much as I possibly can. I can share our social media information. Those are all mine. But if you have any questions, feel free to reach out to me, email me, call me, text me. I try to respond as quickly as I possibly can.
Great. Thanks, Ryan. We really enjoyed having you on. Getting some really good information, and based on the questions we've gotten and then the response, obviously everybody really enjoyed it. And again, those of you who are watching the recorded version of this, you can certainly reach out to Ryan here. His information is on the slide. And those of you here that obviously live, you have it also. So Ryan, I really appreciate you coming on, sharing some really good information. That's, again, we believe very strongly in education here at Advanta IRA for anyone investing in real estate, whether you're using an IRA with us or not. Obviously, we'd love for you to be a client, but if not, we appreciate you sharing a lot of great information in regards to joint venturing and buying notes.
Thank you, Scott, for having me on again.
Good. And just to wrap up the webinar, here's my contact information here at Advanta. If you have any additional questions all about self-directed IRAs, I mentioned a little bit about it today at the beginning of the webinar. Again, the focus was more so on having Ryan share his knowledge on joint venturing and note investing. If you want to learn more about self-directed IRAs, you can go to our website, advantaira.com. You'll see a library of recorded webinars, a list of other upcoming seminars, whether it's a live class at one of our offices in Atlanta or Tampa, or just another webinar. They're all listed there. So at this time, I'm going to conclude the webinar. Thank everybody for attending.